Tunku, on these key findings, is there anything, of our panel, you're the only member to actually be based here in Kuala Lumpur. Obviously, our other two members are local to the region, but you're here in Kuala Lumpur. Is there any findings here which you particularly recognize or particularly resonate with you?
Well, in respect to the key findings, nothing that really surprises me, but these findings reflect some misconceptions that insurance professionals have in respect of captives. And the one I'm going to target is basically the common perception that captives are only suited for large companies. I think in Malaysia we have one big example which is suitable to set up a captive, and that would be the Malaysian bar. Basically, the lawyers would benefit greatly from setting up their own insurance company out of Labuan to underwrite their professional liability coverage for its members. Obviously, large number of members. I think there are about 17,000 lawyers with the Malaysian bar. And the other large group of people who would also benefit from setting up a captive would be the medical profession. Because from 2019 in Malaysia, it's going to be compulsory for doctors all to be insured. At the moment, it's not. So being such a large body of professionals, they would definitely benefit from setting up a captive. So I would say that it's not true that captives are only suited for the largest companies. But having said that, the successful companies that have set up captives in Labuan are the local giants like Petronas, Sime Darby, AirAsia, and Genting. And I think the governor, interestingly, pointed out ride e-hailing services like Grab and Uber, I think would be one which are suitable to set up a captive. At the moment, I think these services have problems getting insured, and in fact, I've been looking at amending or putting endorsements in motor policies to cover such services. So being large, I think they'll be able to benefit greatly from setting up their own captives and insure themselves.
Yeah. Thank you, Tunku. It's interesting on the lawyers you mentioned and the doctors you mentioned, because that's certainly something we've seen a lot of activity in the United States. It's not something we've seen that much kind of captive-style activity in Europe, but in the United States, medical malpractice coverage for doctors is a big driver of not just of captives historically, but today there's still a lot of activity in that area, and also legal groups of lawyers coming together and insuring for things like professional indemnity in a group captive structure or a risk retention group similar to a group captive structure is quite common. So thank you for that, and I think they're nice examples of where captives can be thought about outside of a traditional larger company mindset. So we're going to address some of the more, well, not negative, but some of the drawbacks on the captive community first, and then we're going to end with some more positive outlooks. So Sean, thank you for joining the panel. One of the recurring themes in the survey, as we just touched upon, is this idea that captives remain the world for larger companies. Is this an attitude that you recognise, and why do you think that attitude still exists? Not just in Asia, but in general.
Thank you, Richard. Well, it is an attitude that still persists quite strongly, and I think it's because usually when there is talk about captives, it is from large companies that they introduce their concept of why they actually use a captive, and often enough the smaller or mid-sized companies, specifically in Europe as well as in the US, don't usually are because again, as the governor said, they spend more of their time actually on their work. They don't have necessarily the size to actually contribute and discuss these topics within a wider group, because they basically they don't have the resources. While they use a captive and get an economical benefit out of captive, they don't really talk about it. Thus, they're not visible as such as large companies, and that naturally kind of spills over into other markets like Asia, where again, it begins with the big ones to actually do this, but if only the big ones talk about it, then usually the smaller ones think, well, you know, it's something that the big ones do, but it's probably not for me.
I mean, one thing I'd just like to emphasize is I don't think we're saying that the Asia captive ecosystem is ready to move on from larger companies. I think there are plenty of large companies in the region that don't have a captive yet.
Absolutely, absolutely. I mean, we had a discussion earlier. I mean, some of the significantly quite huge car manufacturers and manufacturing companies in general that currently don't have a captive. I mean, if we look to some countries like, for instance, Korea. In Korea, which has some significantly sized companies, there's one captive. One.
One captive owned by a Korean company.
Yes.
Yeah.
So I think that gives you quite an understanding as to that often, again, because of the specter of, oh, captives are just, you know, a tax play, we're too small. It's something where people just, it's something that we need to get over and help people understand that it's not about those things, it's about creating economic value that helps create a more stable system.
Thank you, Sean. Ludan, obviously, thank you for joining us and welcome to this panel. You're very much in touch with the Chinese market and its captive development to date. The few captives that have been formed in China or by Chinese companies, both onshore on the mainland and offshore, have those companies to date been only very large companies? And is this attitude a familiar attitude you recognize in China?
Yeah, the fact is that for the Chinese-owned captive, they are relatively large. I think the very big reason behind it is the Chinese regulator require that the minimal total assets holding by the parent company is $16 billion. That's the entry level. However, we also see that in the Chinese market, a lot of players, I mean, not the insurance players, they are finding insurance sector is very exciting, and not just as a insurance platform, but more like a SPV to support the general risk management. And that's very good signal in the market, and which create a wave in a relatively smaller entities for both SOEs and POEs. And for Willis Towers Watson client list, we actually are helping the biggest company of China to form their captive, and also some kind of relatively smaller association and small private owned entity to form their captive, and also mutual over there. As the governor just mentioned, is also another very big trend in Chinese insurance market.
And that requirement you mentioned, Ludan, of 16 billion US dollars, is that for a company, a Chinese company that wants to set up a captive, or has to set up a captive on the mainland, or is that also for?
It's for mainland.
Yeah.
But you know, when we are talking about China, we always split the market in two segments. One is SOE, another one is POE.
So SOE state-owned enterprise, yes. POE privately owned enterprise.
Yeah, exactly. Because the SOE is more strictly follow the direction from the government side, but POE is more like a commercial decisions.
So we've also heard from the survey, or I've heard before, that often the major challenge for those selling the captive concept and risk managers who want to explore the idea is this internal challenge that I touched upon in the key findings. And our survey reaffirms this, 75% citing a lack of commitment from internal decision makers. Tunku, in your work in the local economy and talking to people interested in captives, is this an attitude or a hurdle that you recognise?
Definitely. I can imagine in a big company having to go through all the various, the CEO and all that, it can be quite a challenge. But give an example of the Malaysian bar, I mean, which I said was very suitable for, to set up its own captive insurance for its professional liability needs. First of all, office bearers or members of the bar council are all elected. So every 2 years you have elections. So you're going to have people constantly changing. And there would be no continuity of leadership because of the fixed term as well. So this would affirm the point there that there would be lack of commitment for internal decision makers, which would be basically a risk manager's nightmare, because obviously you need risk managers to manage captive risk. So, and I can imagine this risk manager advising a bunch of other professionals like doctors would also face similar problems.
Yeah.
So the answer would be yes. I think lack of commitment or difficulty in getting decisions from the people who give decisions would be a problem.
And Sean, is that an area you recognise on the bigger corporate side? Does that exist there as well?
Yeah, actually, it's funny when you look at the turnover rate in Asia. It's usually quite high, also in the risk management arena, and so the companies that don't have a change in the risk management structure every few years are far and few between. A lot of them tend to have a situation where one risk manager leaves and then joins another company. And so the knowledge that risk manager accumulated specifically on captives and how they could be used usually then moves over, and they start basically from scratch again at the new company if they actually see that the concept would work there as well. And at the previous company, nobody really picks it up because it was usually a single person understanding and concept.
Okay, so we've covered the knowledge gap. In terms of holding the captive industry back here, we've covered knowledge gap and lack of commitment. Now the next one, soft insurance market, is a real frustration, I'd probably say, for lots of people in the captive market, is to the idea that soft insurance market is a reason not to form a captive. So I guess there's 2 points I want to make here before I ask Sean to elaborate on those and provide some more technical detail where I can't. I think it's fair to say that most people in the captive industry would argue that the soft insurance market is not a reason in itself not to form a captive. If you can get cheap insurance, that shouldn't be a reason not to form a captive. But I think it's very important for us in the industry to recognise that it is definitely a factor in holding back, and that might be because of misconception or misinformation. So Sean, are you able to explain to me why the soft insurance market is sometimes a hurdle? First, explain that for me first.
Well, usually people think, well, why should I spend the energy and take on risk when I can actually get risk transfer very cheaply? So if I can transfer my risk to an insurance company, why should I keep some of it, right? I mean, it's a logical thing, right? Doesn't make any economical sense. Now, why it should not be a hindrance is because, well, you still have risk which you don't insure. People always think about risk where they have risk transfer only. So where they normally buy insurance and where they feel, oh yeah, why do they buy insurance? Because they think it makes economical sense. Now, for places where you don't buy insurance, that is where you should use a captive, because it helps you to create economic value and stability, as well as a structure for your risk management. That is where a captive, specifically in a soft market, should be used. And additionally, it can be used as a tool to actually access a larger capacity on the reinsurance side for a basket of risks, which you individually would have a hard time insuring.
Yeah.
So overall, it would be a very good time to create a structure now rather than later.
And I think that last point is quite pertinent as well, that let's say that you go down the route of insuring some risks which you're struggling to insure in the commercial market, or something a bit more interesting, but if you've then got the captive vehicle, you can use that captive vehicle to access the reinsurance market, whether it's through kind of a multi-line, multi-year situation, or just to go and get reinsurance, which tends to be cheaper than the primary.
And actually, I would like to also pick up on a comment the governor made in his keynote speech. He indicated the captive is an incubator for risk, right? It's actually something that helps the market as well as the company to learn about risk and how they can actually better manage the risk, how they can collect data, and thus the industry can actually provide a more solid solution on a going forward basis. Because that's the reason why we don't have insurance products for certain types of risks at this point, because there is no data. And as long as people don't create a product and actually collect data, there will never be a good product.
Ludan, in China, does the soft market come up as a factor at all when it comes to captives, or is it pretty much irrelevant at this point?
Yeah, that's a very interesting question because China is one of the most competitive insurance market in the world. And while I think from our standing for the potential applicants and also the one who are holding captives already, the price of offered by the commercial insurance company is a concern, but not definitely not a major concern. Because the company, they are not just use captive as a insurance transaction platform. That purpose is just too tiny to those companies to make the decision to set up a captive, no matter where it is, mainland China or worldwide. Actually, they want to facilitate that with more functions from it. Maybe more than just a insurance company, but also like a risk management platform and or financial SPV. So that's a very important thing. Secondly, I think the Chinese insurance companies, they are changing their attitude against the captive quite a lot in the past 3 years. Because literally Chinese capital market was emerging from 2013. And at the beginning, the Chinese insurance market, the giants company, they are quite against this concept, fight with each other. However, after 3-year development, they are currently eager to hugging the captives and the coming captives, because they think it's good to play together with a client to have a better quality risk management system, and eventually the bigger potential of a premium income. As Sean just mentioned, some kind of new risks in the market. They need such kind of captives as incubator or trial or flag project to test it. And eventually, I think from the regulatory point of view, because Willis Charles Wilson is acting as the consultant to CIRC, the China Insurance Regulatory Committee, for both captive and mutual regulatory region, and also to SASAC, the owner of all the SOEs for the risk management system in China. We found those guys, the regulators, actually they want to use a captive as a game breaker to create more competition, healthy competition in Chinese market, to create more new products and more approaches of new way to tackle with some kind of risk management approaches, not just for China, but more important, following the one belt one road initiative for the overseas risks.
It was interesting to say about the kind of insurance companies in China previously being skeptical or afraid of captive development in China, because I think that certainly happened in Europe and North America, and the large insurance companies have learned to embrace it exactly why you said, because if you're Zurich or Allianz or AIG, then and the biggest clients in the world have captives, then it's going to be in your interest to serve those captives, offer fronting services, reinsurance services, claim services, all these extra services that you can then add on. These last factors here, other factors, 29% of respondents also cited high setup costs, and separately 29% cited regulatory concerns as to why maybe there hasn't been as many captives formed from Asia as there might have been. Tunku, what's your opinion on the high setup costs part of this? Do you think that's fair? That would be something holding back the formation of captives?
Well, since there are two questions there, I think I'll answer both. So one is, in respect to the high setup costs, I guess these respondents are looking at the high setup costs of hiring a risk manager, underwriting teams that are professionally qualified. And however, these costs of setting up or hiring these professionals have to be weighed against the benefits of establishing a captive, such as one is lower insurance costs, because as the parent can retain the underwriting profits within the group rather than have to go to an external party, the captive may help reduce insurance costs by charging a premium that more accurately reflects the parent's loss experience. The second point is cash flow benefits. By utilizing a captive, premiums and investment income are retained within the group. And where a captive is domiciled offshore, as in Labuan, the investment income may have tax breaks or tax benefits. And the third thing is increased coverage. A captive may provide coverage required where the commercial market is unable or unwilling to provide coverage for certain risks, or where the price quoted is unreasonable. And one example we have is product liability, especially your manufacturing airbags. Our firm's been handling quite a bit of litigation involving exploding airbags, and or extended warranty insurance for vehicle manufacturers. And it was interesting what Sean said just now, that Korea, which is such a big vehicle manufacturing nation, has only one captive. I'm not sure about Japan, but it's stark contrast that they can actually risk manage themselves and get financial benefits from setting up a captive. On regulatory concerns, I guess some jurisdictions may have some regulations that are not beneficial to setting up captives. However, since I'm Malaysian and I have to tout Labuan, I would say that the robust regulatory framework here is, or in Labuan, is attractive for the establishment of a captive. And this is provided by clear legal provisions in the Labuan Financial Services and Securities Act 2010 and the Labuan Islamic Financial Services and Securities Act 2010. These are legislations governing, in respect to the second one, is the legislation governing Sharia-compliant financial services, and also, obviously, Labuan touting itself as an Islamic financial center as well, and of course, the guidelines that go with it is the guidelines on captive insurance business in Labuan, international business, and Labuan as a financial center.
Thank you, Tunku. I think it's important to mention on the on the setup costs. It depends how you define setup costs, because obviously setup costs, there might be the application fee in the domicile of choice and the capital requirement in the domicile of choice. But then, as you mentioned, internal setup costs, maybe paying for a feasibility study, paying for all these legal services, etc. These things are going to add up. So it's obviously important for captive owners to kind of consider those. I know there's a session on feasibility studies coming up later, so I guess that'll be addressed then. On the regulatory concerns as well, I think there's two parts, well, probably more than two parts, but the two parts that stand out to me for regulatory concerns are kind of your internal regulatory concerns in terms of in the country where the company's from. Is your local tax authority going to be happy with you setting up a captive somewhere? And then the regulatory concerns around the domicile of choice, and then, of course, writing insurance of your own insurance vehicle around the world, that might produce some regulatory concerns as well. So I think both high setup costs and regulatory concerns are multifaceted, and I think they are obviously going to be considerations for someone when they're considering setting up a captive. Okay, the last part of the negative side of this presentation is the common misconceptions. And I guess what I'd like to say before we get into these common misconceptions is I don't think these are unique to Asia, particularly tax. I think this is a global misconception problem. Sometimes it is a misconception, and sometimes there are genuine concerns around tax and captives. So captives certainly still suffer from suspicion, as the governor said in his keynote regarding their tax arrangements all around the world. The OECD's BEPS project is a good indication of this at the moment, particularly in Europe, while in the United States, the Internal Revenue Service have been very aggressive with regards to particular types of smaller captives, as I referred to in my opening as well. Ludan, I'd be interested to hear from you on this tax piece. How is this discussed in China, and do the authorities view with suspicion companies that set up a captive in an international jurisdiction?
Yes, okay, I will talk about this question through the traditional two segments of the Chinese companies. First, the SOEs, of course. And I think for SOE, especially the onshore domiciles, tax is not a concern at all. They don't care how much they pay to for the tax part, because the government owned. Well, of course, for the financial projection side, they will consider that factor, but definitely not a big concern. Well, as for if they are trying to set up a captive overseas, it will be on the top list, but definitely lower position than the political concern. So I would say for commercial decision, tax is one of the concerns, but not a major one. While for POEs of China, Yes, because they are making decisions mainly focused on the commercial reasons. Tax is as important as other commercial factors.
Thank you. And on just lastly on that, Ludan, is there ever a case where, for POEs, could the Chinese government or Chinese tax authorities step in and stop? Do they have to have almost an approval if someone wants, if a Chinese company wants to form a captive here in Labuan or Singapore or Guernsey or Bermuda? Can the Chinese government have any influence on saying, no, we don't think that's the right thing?
Actually, it depends on where the money comes from. If it's from mainland China, of course, because China is a foreign currency control country, so you need to apply for the approval for it. But if the money comes from outside of China, there's no matter at all.
Tunku, on this tax piece as well, to you, how do you see this misconception having an impact or materializing here in Malaysia?
Well, I think, again, to say that it's pure tax plays is a misconception, because I think tax should not be the main consideration setting up a captive. And as mentioned earlier, the main benefits, I would think, are lower insurance costs, increased coverage, and cash flow for the company that intends to set up the captive. So my answer to that is probably this misconception has to be tackled by maybe educating the respondents in your survey to the other benefits of setting up captives.
And Sean, so on these last two pieces here, complexity and company size, nature of operations, so we see here at the bottom of this slide, 11% said or point to the need, they believe that you need to have international operations for a captive to be feasible. So on these 2 points together, complexity and then kind of company size and company operation, when it comes to education, Sean, which Tunku just mentioned, is there anything, what does Zurich do on this? So can Zurich do anything, and is it the job of the industry to educate clients and kind of alter these mindsets?
Yeah, absolutely. I think it's an important piece that the industry actually helps the risk management community to better understand insurance, because the risk management community is mainly concerned about risk management, right? Insurance is just a way of mitigating and transferring risk, but that doesn't mean that risk managers per se always understand fully, what they can do with insurance, especially also with self-insurance, right? And so we need to, me personally, I usually talk to individuals to try and actually walk them through ways that how they could use a captive, how they could use a captive to actually manage the risk, specifically, again, to what I mentioned earlier, help them deal with risks that they currently don't really deal with, meaning in terms of risk transfer, right? So where they don't buy insurance, because that's really the area where they need to do more within their company to actually add value, right? And a captive can be basically the balance sheet of the risk management function, right? Where they can also demonstrate to the company, as well as everybody else, what they add to the company, rather than just being a function where, they manage insurance and the insurance cost.
And on that last point, one of the common ones we see, I think particularly more often in the United States and Europe, but when you say about using a captive as a risk management function, as the risk management balance sheet, we often see captives used for risk engineering kind of projects, which you can then reward your subsidiaries if they've then used risk engineering, improve their risk profile, then obviously their premiums should go down. But you can use the captive's balance sheet to fund risk engineering projects and loss prevention projects. And that's kind of what you're talking about.
Yeah, exactly. It's basically a positive spiral that you can create, because usually the one issue that companies have when it comes to risk improvement action is, well, I didn't budget for it. Where do I get the funds from, right? And usually people say, well, we cannot really just give you that. And again, here the captive, with the funds that the captive has, can help, because essentially it benefits the captive, right? Because they improve the risk of the company. And overall, it actually improves the companies as well, right?
So we're going to move on to the more exciting part of the presentation, which is the drivers, so what we believe, or what our respondents believe are driving new formations or will drive new formations. I will just mention, I think we should have time for questions at some point, or we can take questions now. So there's a question here. We've got a microphone for the gentleman.
So just to remind you, we have placed microphones along the aisle. All the microphones are on, so please do not touch any button. You may switch it off by accident. The controller will then unmute the mic, so if there is a slight delay, just hold on, they will unmute the mic. And we have our gentleman here all the way from the Philippines with the first question.
I have a question. Isn't self-insurance also retaining the risk of a company? And you put up a captive, it's also an insurance company. And they also have to revert to reinsurance to protect. Am I right or wrong?
Yes. Yes, so Sean, I mean,
For example,
captives often do buy reinsurance.
Yes, correct. I mean, it really depends on the risk strategy of the company and how they want to use the captive. For certain risks, they might not want to actually buy reinsurance. For other risks, they will want to buy reinsurance. And again, in some cases, it's a tool that can actually help get reinsurance coverage for a basket of products where they individually would not get reinsurance.
that's what I mean. It's actually another insurance company. It has to be controlled, also regulated properly by the government. And I think that they need good risk management. Otherwise, self-insurance can be very dangerous. For example, British Petroleum self-insured themselves. They forgot about the pollution risk. They almost got bankrupt because they had to pay a lot of claims.
That's very true. But in the end, when you look at self-insurance, and the question is, if you don't buy insurance, you're already self-insuring.
Yeah, but you still need reinsurance.
Yeah, exactly. No. I fully agree with you. When you self-insure, but if you don't buy any insurance at all, you don't have a captive, you're already self-insuring and you don't have any ability to buy reinsurance. So only by actually creating insurance, then you can actually buy reinsurance.
That's what I mean.
Yeah.
For example, in the Philippines, we have only one captive company. And they cannot sell insurance, but they're regulated same as an insurance company. Because if they fail, if they self-insure too many of the company's risks, even if they cannot buy reinsurance.
Yeah, it's important to mention all captives, I'm pretty sure I'm right in saying that all captives are regulated as insurance companies. So every single captive in the world, some are regulated better than others, and some domiciles regulate better than others, but they are registered insurance companies, and you can only access the reinsurance market if you are a regulated insurance company. But I need to speak to you because I need to add Philippines to my list. I didn't know there's one in Philippines, so I need to add that to my statistics. So that's one extra one for Asia. Let's put that up.
Thank you very much,
I
Mr.
just thought,
Didios.
After being in the insurance business for almost 70 years, I'm 90 years old. I think that I wanted to contribute to this session, my thoughts.
Thank you. Thank you very much.
Thank you very much, Mr. Didios.
So, and yeah, if there are any questions, then do put your hand up, but we should have time at the end. Oh, we've got one more there. We'll take one more now, and then we'll move on to the timers.
I have a question here. And it's, I guess, following what was mentioned by the previous participant. How much of the risks taken up by captives are actually retained, i.e. self-insured? Are there statistics on that? And how much, and also, what would be a difference, if you like, between the loss ratio that a captive would actually experience and the loss ratio that, effectively that was insured directly? I think the point here is that the idea of a captive is that when you self-insure, you have an interest to manage that risk continuously. Whilst if you risk transfer, you insure, once the risk has been underwritten, there's not much incentive, as it were, to continuously manage the risk. So the idea of a captive is effectively to provide a way in which the owner of the captive to control the total cost of managing the risk, i.e., when I say total cost, the loss that it incurs and the loss and the cost of insuring the risk.
Yeah.
So the point here is that if you take away the benefits that you get from tax and the benefits that you get from taking away the middleman, i.e. the insurance company, you actually see a savings in terms of the total loss plus the total cost of insurance to the owner of the captive. Because I think it's crucial, because I think in some jurisdiction, the regulator discourages captives because they see it as purely a play on tax,
Yeah.
and a way of which actually avoiding going to the insurance companies domicile in the country.
Yeah.
You have to prove that effectively this is effectively an economic way of managing risk.
So we'll try and answer those two first questions you asked. So Sean and Ludan, correct me if I'm wrong, but I think on the question on retention levels, in terms of what level retention captives take before passing it on to the reinsurance market, that varies captive to captive. There's some that will pass it 100% through and not take any, and there's some that will take all of it, and there's some in between.
Yes, it usually depends, again, on the risk. It's usually determined by how much the company can actually influence the risk and how much of that risk and coverage is more of a cat type risk, which usually don't occur on a regular basis. When I say regular, I mean multiple times during the year. So it's really about controlling risk and also driving the company to actually, again, do things to mitigate risk, right? Because again, if you pass on risk to an insurer, as you said, the company doesn't have any incentive to actually improve the value of their risk.
Yeah, it really depends. I think there are a lot of factors on that. I think, first of all, it's your own risk management strategy. That's very important. And I think in addition to the total cost of risk management, I would also mention the consideration of the cost of capital and also the gain from the investment, because it's a full pack game. It's not just insurance. And on the other hand, if we look into the BP case, as the gentleman mentioned at the first place, they don't buy any reinsurance, but they have full reason behind this, because they find they are capable enough to manage their own risks. So it really depends on different company and the different level of maturity of risk management.
Regarding the data as well, on retentions, AM Best might do some data on retentions, but only on the captives that they rate. I don't believe there is an industry measure of how much retentions captives are taking globally, because captives don't like to share information, unfortunately. That's the challenge that I have every day doing my job as editor of Captive Review magazine. On the ratios, I know AM Best do have good, great information on the loss ratios of captives. And that would be the port of call. I can't think of it top of my head. I think the loss ratio is generally a lot lower. Is that right?
Yeah, usually it's lower, because again, the interest of the company is to actually drive down that loss ratio, right? I mean, again, it's the usual benefit of a captive. And actually, I just wanted to also add the point about tax and cutting out the middleman. Usually, because a captive is an insurance company, it has a license, but only in its domicile. And so if the risk is in another country, they still need to work with an insurance company to actually cover that risk locally, because usually you have, by the local market, as a prescription that you have to have a license in the market to provide insurance. So it's not really cutting out the middleman per se. It's more about actually having that risk which you can manage under your control and retaining it, while the other part that you cannot control, that you transfer.
So in that scenario, the captive is almost the middleman. Is the captive not the middleman then, basically? Yes. Okay, so if you go back to this PowerPoint presentation, we're going to talk about some of the drivers. Well, we talked about the drivers, haven't we? Where are we going next? Okay, future and domicile perception. Great, we've got 9 minutes, so we've got plenty of time to talk about this. and then maybe some more questions as well. I'm going to keep an eye out, so if you do have a question, put your hand up, and we'll find a good time to come to you. Growth potential. Only the good news for everyone in this room is that only 7% said they expected there to be no increase in the number of captives domiciled in Asia. 36% said there was strong growth potential, and 57% said they expect it to grow at the current pace, which is, to be honest, pretty modest at present. So I think most of us would like to see that rate of growth pick up. In regards to the kind of the future of the captive sector in China, Ludan, is there a relative consensus as to the rate of growth that you'll see in China? Are you expecting to see big growth, kind of continue the same? What's the thought pattern?
I would say the worst scenario would be keep the current pace in China, because if we don't consider the coming change of the regulation part, even just look at the threshold of parents' total assets. There are over 120 companies in China who can hit that target, and just 6 of them have captives. So it's a huge potential over there. And on the other hand, it's for sure the regulator is going to change the current guideline on captive. So that will give more flexibility to both SOEs and POEs to set up a captive, especially in mainland China. But on the other hand, as we just discussed, for the relatively smaller entities in China, they are taken captive as a positive financial SPV, but not just for mainland China, but for worldwide business. So I believe there will be a huge wave come from China, spreading all around the domiciles around the world for different size of captives, from huge one to relatively smaller one.
Thank you. And Tunku, on the kind of the rest of Southeast Asia, or the region that you're focused on here in Kuala Lumpur and Labuan, where do you sit on that scale? Do you think we'll see growth at the same pace here? Do you think there'll be strong growth potential, or do you think there's going to be no growth?
Well, to be honest, I have no idea, but but hopefully, I mean, obviously being supporting Asia, supporting Labuan, I hope there is growth, and I think the conducive investment atmosphere in Labuan, and of course, being a Sharia-compliant jurisdiction, it should. I'm positive there should be growth.
Yeah, and Sean.
I think there will be growth. I wouldn't call it explosive, but I would consider it a very a slower moving, but continuously picking up speed. Because again, it's a little bit like dominoes. Once the first it starts moving, it becomes faster. It becomes a little bit of a snowball, and people see, because there's more talk about it, more people know about it, more people learn about it. And I think it will come from various countries. So it will be China. I have expectations for Korea. I think Malaysia will do quite a bit as well. Singapore, Australia not so much. Japan, a little bit slow. Philippines probably will see some as well. And we will see maybe something out of Thailand and Vietnam.
What's interesting with Japan, you mentioned, is Japan probably has been one of the countries to be more developed, and they've made use of, I know there's a few Japanese captives here in Labuan. Micronesia has been used traditionally by them. Hawaii, I know that Hawaii has been licensing quite a few Japanese captives just in the first 6 months of 2017. So I was surprised to hear what you said about South Korea, because I knew that Japan was quite far along on that journey, both large and smaller private companies. But it's interesting that South Korea hasn't quite caught up. So just lastly, we're going to end on some of the statistics we gathered regarding Labuan itself as a domicile. And I think they're quite impressive results, so kudos to everyone here who's been involved with Labuan. 64% said they believed Labuan has a fair reputation as a captive domicile, while 32% said its reputation is strong. and 70% said they would feel very comfortable using Labuan to domicile their captive, or very comfortable to service a captive which was domiciled in Labuan. Tunku, obviously you've been involved with the insurance industry for a while here. How have you seen the jurisdiction evolve as a captive domicile over the years?
Well, as Malaysia and its neighboring countries and the Middle East are looking at more Sharia-compliant jurisdictions, I think Labuan has evolved nicely, especially with the Labuan Islamic Financial Services and Securities Act 2010, which is the legislation governing Sharia-compliant financial services in Labuan. So I think it's poised.
Yeah,
it's poised to evolve nicely.
And Sean, from your experience of working with obviously captive clients around the region, how does Labuan stand up to kind of Singapore and its peers in the region?
Well, I think essentially you have two places to go to. You either go to Singapore or you go to Labuan, and it really depends a little bit on what you're looking for in terms of the structure as well as the domicile itself. So I think essentially what we will see over time is continuous growth in Labuan as well as growth in Singapore in both domiciles, while other places like Hong Kong and Micronesia, as well as some of the other ones aside from China, because again China is a very special case, will likely be on the very stagnating side of things, because they don't have enough pull, I would say.
Thank you, Sean. Okay, well, I'm happy to wrap it up there, but obviously we do have a couple of minutes available if there are any burning questions from the audience to our panel. Otherwise, yes, we have one hand up here. We've got a microphone coming.
Hello, good morning. My question is, for a captive company, when you sit out to reinsurance, you have the exposure of credit risk exposure. Now, the question is, for an insurance company, we also have the credit risk exposure, and we manage that well. For a captive company, how do you consider, or suggestions, how do they manage the risk exposure? Thank you. Credit risk exposure, I mean.
Sean, you're the fronting expert here, probably the best one for you.
Well, usually, again, it's applying a similar type of approach as you would on a normal type of reinsurance structure that you will look at. Usually you would look at naturally rated companies with a strong rating and that are usually working in that space anyway. Usually you go from a normal traditional kind of program structure to a captive with a reinsurance structure anyway. So usually you bring along the ones that you already are familiar and accustomed to, rather than to really select a new panel. Because again, for them, working with a captive is not really any different. It's just a slightly different structure, and actually often it's more attractive because the company owning the captive takes more care in terms of their risk. Does that answer your question?
Of the captive. Sorry. Yeah.
Well, yeah, but I mean, essentially, you have a usually you would have a fronting company, a captive, and then the reinsurance. If you are too concerned about having too much credit risk exposure within the captive, you can also just do what is called a net structure, which means you only, from the fronting company, you only cede the risk that the captive wants to retain to the captive, and the rest goes directly to the panel. So you cut out that reinsurance risk, you transfer it to your fronting insurer. That's the easiest way actually to do it.
We'll take one from, there's a microphone coming your way, Steve, and then that'll be the last question.
Hi, it's Steve Tunstall from the Pan Asia Risk and Insurance Management Association. I'd like to step back a little bit and say, just get the panel's views on the theme of the conference, really, about the growing role. I see from the work I do right across Asia and Europe that there seems to be a huge increase in the regulatory burden in Europe and perhaps to a lesser extent in the USA. Does the panel see this as the huge opportunity now for Asia, a huge opportunity for big companies in Asia to bring their captives back home from Europe or other domiciles, and to really drive the message home now in Asia that this is a great tool to use to manage your risks? Thank you.
I think on that point, Steve, I think it's a point well made. We've done a lot of work at Capture Review on analysing how Solvency II is actually being implemented for captives in European Union domiciles, and that has been very inconsistent and quite burdensome, as you say, for captives in the European Union. And then if you couple that with the economic growth and maturing domiciles here in Asia, if you've got large multinationals which have a much more growing book of Asian business and Asian operations, it becomes much more suitable perhaps to put a captive here, whether they're an Asian corporate or they're a European or American corporate. So I think that's fair. I've heard a few examples recently, and I won't name names because some of the consultants are in the room, of American firms looking to set up captives, and rather than considering Vermont or Ireland, what they might consider previously, Singapore is on the agenda. And that's because I presume this firm has large Asian operations. So I think if the message can be got out there that these domiciles are open for business here and willing to work with captives and regulate them appropriately, but I certainly think there is an opportunity for Asia. Ludan, Sean, Tunku?
I fully agree. I think actually it's an opening opportunity to repatriate, but as well as attract actually European domiciled companies to the shores of Asia as a place for captives. Because one comment I got from some European captive owners was that their location, their domicile has become too bureaucratic, and they don't have enough interaction with the regulator. They're not able to talk to the regulator. They feel like they're just a piece of paper, so to speak, right? And they want to have that interaction. They want to help to kind of grow the domicile, help to actually develop it, and help to kind of enhance what there is, rather than just to have basically the regulator have their set of rules and that's it, and there's no real communication.
I think from China point of view, because regarding the international wave, I think it's better to consult my colleague, George McGee, sitting over there, who is in charge of Asia. While for China point of view, actually, I think at least for the some kind of Chinese cities, they want to create some kind of onshore domiciles for offshore business and try to leverage the big economy of China to attract more captives over there. Maybe not just 100% move the European-based captive into China, but however, to set up branches or subsidiaries over there. That would definitely, I think, be some kind of expectation from the Chinese local governments.
Okay, so thank you to our panel. I think we should be ending on time now. So thank you to Tunku, Ludan, and to Sean, and thank you for Lab 1 IBFC for collaborating with us on this research project. Thank you.
Ladies and gentlemen, a round of applause for the moderator and members of the panel. Thank you very much, gentlemen.